What's up, everyone? It is E-Money, your BFFF, best financial friend forever. So we're at the end of the year. Solvency is a big deal for a lot of people. And I think a lot of people just have a misunderstanding of what solvency actually means. But the good news is that in this latest episode, we actually tackle the subject of solvency as it relates to your practice, as it relates to your household, and what are the 7 ways in which you can ensure that you are solvent. So I have no doubts this is one of the most important episodes that we've ever done. I definitely want to make sure you guys take a listen to it. As always, please make sure that you give us some support with this channel, and also let's start doing something to improve your finances. So what does that mean? Well, one thing you can do is go to our website. You can schedule a call with one of our consultants, and they can get you on the road to financial independence. There's no better time than right now. In the meantime, I want to make sure you guys really enjoyed this episode because it has everything to do with your freedom and financial future. And of course, we want the best for that. Okay, I'll see you guys on the next podcast.
What's up?
Just living the dream.
I don't think you are, but that's just because I know a lot of intimate secrets that you have. That
well, how about this? While I have you live with millions of listeners, let's talk about how big of a raise are you going to give Eric Gersh this year?
Not much at all, actually. You know why?
Why?
So I'm going to have Eric Gersh give himself a raise.
Oh, here we go.
Right?
Here we go.
Give himself a raise by like having an added target of like, this is what I'm going to do to make, not only my life easier, but the lives of all my clients easier by, getting them into a condition that they have never, ever even imagined they could be.
Well, that is what we do on a day-to-day basis.
It is what we do on a day-to-day basis. But no, I'm not. I think we're actually evaluating a couple of the benefits right now. That could be like almost like a raise, but we'll see.
All right.
So we're trying to do whatever we possibly can to take care of our employees.
I'll give you some input off air on the benefits thing. I actually do have something to, on a serious note, to talk to you about. But
okay, I would like to hear.
Besides the fact,
I would like to hear that. But what we talk about the most, at least here, is solvency.
Yep.
Right? Like, and I would say that because solvency, when you look at it, is really the cornerstone of like any organization being able to expand. Is that you got to be solvent.
Yeah.
And, how we define solvency, I'm trying to remember like a good definition for solvency. Let me see if I can just bring one up here really quick.
I've got one.
Tell me what yours is.
Well, my definition of solvency is enough money coming in on a monthly basis where you're able to pay your operating expenses, your taxes, your debt, and you're able to save right off the top, your 10% that we always talk about.
Okay. Good. I mean,
it doesn't just mean, I think when people hear solvency, largely they think about, okay, is there enough money coming in to cover the operating expenses and keep the doors open? But that's a business on life support. That's not a solvent business.
Yeah, if you look at the definition of solvent, it says to be able to pay all legal debts. Wow, that's terrible. Let me see where it comes from. It comes from the Latin to dissolve, which obviously is like you've heard of a solvent that can do that. So. But no, solvency is when there is more money coming in than what's going out. I mean, I think we can make that a simple one.
Yeah.
And but to your point, it really you need to have all those things factored in to actually be solvent.
Yep.
So you have to have your reserves, your operating expenses, and both at the household and the business level.
Yes.
And just by and far, I mean, most people are insolvent. Most practices are insolvent. Now, that when I say that to them, they're like, no, I'm not. I'm paying my bills.
Yeah.
I'm like, okay, great. But that's it. There are no other margins there, or very little, or not enough. So technically you are insolvent.
Yeah. You're not, you're surviving. You're not thriving.
Yeah. So it's like, I think that's the first like reality point. You got to realize like, I'm definitely insolvent.
Yeah.
Because if you don't realize that, nothing's going to change. You're going to be
a
like,
tough pill to swallow.
Yeah, I'm doing okay. It's fine, but technically you're insolvent. So that's the first thing that we have to like make sure people realize. But what we're going to go over today is what we're going to go over the 7. What's the topic? 7 solvency tips, or
7 solvency solutions.
Solutions.
You should know this. You wrote this.
I did write this,
Dude.
but I forgot all about it.
I'm concerned about you.
So what I'm going to have you do now is go through each point, because you actually have it up.
I do.
And I'm gonna have you recite to me what it means to you and how you apply this in your life.
Okay.
Because this is exactly how like learning gets done. It's not just sitting in front of a computer reading something. It's how do I apply it to my life? So, Mr. Gersh, tell me, what is the number 1 solvency solution?
Well, number 1 is to review your finances at least weekly.
Yes.
You've got to be on top of it, right? This isn't something where you just look at the end of the month and, move on. It's something you have to be actively on top of.
Yeah. So if I'm an owner, what does that mean?
Well, I would say, then once a week, you're looking at your QuickBooks or whatever software you use. You're looking at the, how much has came in.
Yep.
If you deal with like insurance, your accounts receivable, how much is outstanding to collect.
Yeah.
What needs extra attention to collect. What bills are due. What's in the bank account.
All good things, I think. Just doing that, you're going to pay attention to
just a big picture overview of all your incomes, your expenses.
Yeah, know what's coming in, know what's going out, have a pulse on, what should be coming in, what should be going out. So you're not like in a mystery about the finances, as opposed to, I don't know, I never look at it,
Exactly.
What we've heard some people say. So, okay, good. That sounds like a solvency solution, like actually pay attention to this stuff. What's number 2?
Number 2 is having correct income targets.
Oh, snap.
Yep.
So I think we kind of just talked about that, but what does that fully mean to you on the business and personal level?
Well, I mean, for most of our clients who are practice owners, right, the solvency of their practice is the solvency of their household.
Yeah.
That's where the majority, if not all, personal income is coming from.
Mm-hmm.
But you need to know how much do we need to produce this month to be able to cover our business expenses and flow enough money to the household where I live the life I want.
Yeah.
So it just goes back to, looking at how can we generate more income per patient seen?
True that. But I think it goes back to the allocation of money to create the right necessity level. Right?
Yeah. Oh, absolutely.
So I need something. Like money comes from demand.
Yep.
I wonder what would happen if we took away taxes. Do you think it would actually be a detriment? Because right now people make money because they have to pay their taxes. What if they didn't have to pay their tax anymore?
I really don't.
It'd be interesting to see what would happen.
I think for your average American, I think they would just spend more. I don't think anything would change.
Yeah, they would just direct it somewhere else.
Everyone likes to think they would save it and invest it, and but most people would just.
No, observation has taught me that, people, when money comes in, people spend it.
Most people will spend whatever they make.
All of it, every bit of it.
Yep.
So going back to that, you have to have the correct numbers because, you just do. It's like that's to me, it's the most vitally overlooked thing that we try to impress upon people is just don't be wrong on your estimation of what you need to bring in.
Yep.
Just don't be wrong about it. Like, have the right number because
and to do that, you have to know, like, okay, let's say I'm a veterinarian and I have a practice. How much should my associates be producing? Right. If you don't even know what a associate should produce, you can't have correct income targets.
Nope.
So,
do you guys know what you should be producing?
I have no idea.
It's just a flat out lie. I just
kind of show up every day and I don't even know what am I doing? Where am I?
You remember my name?
Yeah, I don't know. I just started coming through the door, 8 years ago, and I just kind of never stopped. So,
yeah.
Of course I know what I should be producing.
Yeah, but also you know the number, but then you know exactly where it's going to come from too, right?
Largely,
we have the 3 categories that where your targets are going to be, and then you can work backwards from there to be like, okay, this is what I need for, planning fees, commissions, money management fees, all those things. So it's broken down. How to go get it.
Yeah.
Like, how many associate doctors have you ever sat down with that actually knew I'm going to get, this is probably a good exercise for them to do. Like, I need to do blank amount in production, $900,000 in production. I'm going to do 400,000 from, spay and neuter, 300,000 from, I don't know that anybody's ever done that. Maybe they do, maybe they don't. I don't know. But I don't think
I don't know how practical it is though, because
well, you kind of know from a year from like the previous year.
I guess you could look at averages, but
yeah,
I don't. Yeah, no, never done that with. It's always just been the big number, right?
Yeah, which is fine, which is more than what most people are actually doing right now. But you got to be correct on your numbers.
Yeah,
with when estimating how much you need to bring in, and obviously that starts with making sure that you count your profit accounts as part of that equation. And if you don't, then you're just going to be operating on the wrong number. What's number 3? So, Carresso, we're at review your finances weekly, have the correct numbers for income,
and delegate financial matters to competent personnel like Eric Gersh.
So, delegate. So that means delegate. Right?
Delegate.
Which means that you're not going to be doing, like, what are some of the functions, obviously, that would include? So,
one of the most common ones I see is bookkeeping.
Yeah.
Right? Of course. You have the owner who's the doctor who's spending X amount of hours bookkeeping each week.
Yeah, they shouldn't do that at all.
Pay someone to do it and see patients. You'll generate way more money than what you're saving.
Yeah, what's a bookkeeper cost a month? $500, $1,000, somewhere around there. I mean, it's like you can generate way more money than the time that they're going to be doing, the bookkeeping. Is it good for you to do at some point in time just to kind of get a feel for it? Sure, but it's certainly not a task that you should do. And there's bookkeepers out there that make nice, pretty reports, and it's accurate. And, I think it's certainly an activity you need. What other areas would that include? I think the day-to-day management too of like, because a lot of people give their practice manager access to the finances as well.
Yep. That's what I was just going to say.
So expound upon that.
Yeah. Your manager should be able to pay some basic bills and stuff. You're always going to have the final oversight.
Yep.
Because we've seen numerous clients get ripped off. But, you shouldn't have to spend your time paying a vendor.
No. No.
Right? The manager can do that.
Yeah.
Credit card bills.
Get some other people to do some of these functions.
Sending in, timesheets to the payroll company, right? Those are all things that you can offload to your manager.
Yeah, for sure. I mean, there are definitely functions and things you can task that you can outsource, other things as well. Just make sure that people are competent and they're trustworthy. Okay. And they're not like, they don't yo-yo in life like dramatically. They're up, they're down, they're up, they're down, because those are the people that kill you.
Yeah.
So you do have to be a bit of an observer of human beings and look how people handle money and make sure that you're keeping people that are, well, maybe I talk about it later on these. I can't remember what the other points are.
No, you don't. But yeah, I mean, you just have to be, long story short, you just have to be careful who you give access to money.
Yes.
And even if you are careful, you still you can trust but verify.
Yes. You have to make sure. Because
in my experience, the people who 8 out of 10 times when a client gets money stolen from them, it's never the new employee. It's always someone long-term who's been trusted, who had some situation arise in life. These aren't people that came in hoping to steal. These are people who life pushed them in that direction and they saw an opportunity.
They had a confusion in life that occurred where they didn't know how to solve a problem, right? And it resulted in bad behavior, criminal activity, whatever it is. Okay. Yep. So you're right. It's usually the manager I've had for 30 years.
Yeah.
Or the blank person who just got into something, So make sure you're talking to your people. Just, interact with them. Yep. I mean, I try not to talk with some of my people, but for the most part, I talk to most of them. Maybe too much, so maybe I know too much. I don't know. What's number 4?
Knowing and understanding the difference between what is an expense and what is a investment.
Okay. Why is that important?
I don't know. Let's use marketing as an example, right?
Yep.
Marketing is an expense, costs money, but it's really an investment, right? Because you're spending, I don't know, say $1,000 with the hope that the end product is that you get 3,000 worth of new business.
Yeah, for sure.
Right. So it's a investment in a sense. And that's important because a lot of times when people are struggling financially in their practice or whatever, their first inclination is to start cutting. And, a lot of times they'll cut things that they shouldn't cut, the things that help them grow, their marketing, their consulting, anything that's there to grow your business shouldn't be cut when times are tough because you're just shooting yourself in the foot.
Yeah, I think that goes back to you cannot economize your way into solvency.
No, I always say that to every client when things are tough is you are never going to cut your way out of this problem.
Nope.
Little cuts here and there, sure. Can they help?
Sure,
I'm not going to say that you shouldn't. You should definitely analyze your expenses, see what you can reduce, be smart, 100%. But, cutting expenses solves 20% of the problem. Growing the production solves 80% of the problem.
Yeah, because where are we going to look at? We got the 3 big bucket of expenses. We got payroll, we got facility expenses, and we got like your divisional and overhead expenses, cost of goods sold, merchant fees. I mean, you can look and inspect there. Okay, maybe benefits or something like that. You can look at your practice facility expenses, but there's probably hardly any place that you can cut that. That comes to payroll then, right? Yep. Which is really a big expense. And I would say that it's not so much you're cutting it, is that you're not getting production from people.
Yeah.
And that means that you're doing something like, what do I do here? Yeah. Now you could cut someone that's not doing a good job and has just been like displayed that consistently they're going to suck forever. You know, that would be an example of doing that. I dare say you did that, it would probably lift the spirits of everybody else.
Yep.
And I, honestly, when I've seen people that have let people go that they thought that they couldn't, everyone kind of rallied around it and was really happy afterwards.
Yeah, it tends to work out.
Yeah, it always tends to work out. But yeah, you can't economize your way into solvency. You have to grow, and that means you have to market and put money in things that are going to create more value for the business. That's what the investment part is.
Yep.
Okay.
All right.
So what are we on, 5?
Number 5.
Yep.
Is having a effective system for collecting on your receivables.
Oh, snap.
Yeah. So this doesn't, I guess this probably applies to everyone. I know vets really don't have receivables, but some of them do. Some of them do.
But it's getting money in the door. They give a lot of stuff away.
Yeah.
Some vets do,
True.
And so I think it just goes back to you guys deliver a service. You went to school, and your providers and the associates went to school to learn a skill, and you need to get paid for it.
Yep.
So you need to make sure that money is coming in the door. And
on money that's owed to you, you need to follow up on it.
Yeah.
Aggressively, but professionally. But you can't just hope that people pay you.
No, and look, in the reimbursement world too, it's like they're actively doing whatever they possibly can to deny your claim.
Yep.
For the most part. So you're going to have to fight fire with fire.
Yeah.
And, whatever that means, having a good system for collecting money. And if that means that you're not good at it, so you got to outsource it, that's what you got to do.
Yep.
So it's imperative, though, that you get people that can ask for money in an organization. Like they can just say, whether it's like a treatment coordinator or a front desk person or whoever it is in your office, it's like, no, we did this. You need to pay us for it.
Exactly. Yep.
So number 6.
Dips in practice revenue
are
addressed immediately.
Oh my God. This one drives me batty.
I know. I was waiting for it.
This one drives me batty.
So, it's something where if you see revenue declining, you don't wait 4 weeks to address it,
And you certainly don't just sit there and look at it and be like, well, there's nothing I can do about that. Like, really?
Yep.
You can't get people on the schedule. You can't call people. You can't start a marketing campaign. You can't meet with your associates and find out why they're not producing or asking for referrals or anything like that. You tell me there's nothing you can do about that?
Exactly.
That's not
you
true.
You just listed 5 things in 4 seconds that
you could go do that would have some impact on your finances. So a dip is a dip. Regardless of why it happened. We've had that. Hey, there's a week where we were gone for 4 or 5 days.
Yeah,
going to be a dip.
Happen.
There'd be a dip. Yeah. But how do you react to the dip?
Exactly.
How do you react to the dip? Do you allow it to continue to occur, and then do you allow it to just continue on to a lower trend, which is exactly what happens.
Yep.
So address the dip immediately.
Immediately.
Don't wait around. Address that dip immediately.
Yep.
Okay. Let's see if I can go through all 6. So first one was review.
There's one more.
I know, but I want to see if I can remember all of them.
All right.
So review your finances. Have the correct number. I already forgot number 3.
Delegate
certain actions to somebody else.
This is bad.
Collect money. Make sure you have someone collecting money. What did we just go over? Yeah, I'm pretty terrible right now.
It's like a train wreck. I want to look away, but I can't.
Give the other 2.
Knowing the difference between an investment and an expense.
Yep.
And the last one, that we just talked about, addressing.
Yeah, addressing the dips reading. Okay, what's the last one?
Last one's kind of similar to the second one, I guess, but understanding and tracking the practice's make-break point.
Yeah, it's that important. So we want to mention it twice.
Yeah.
Just in a different way.
Basically.
Yeah. Like your make break number is your make break number. And it's not just your make break number for being able to barely survive. This is what we need to bring in, including our profit accounts. So we say it twice because it's just that important. Know your make break number. And if you don't know how to figure that out, then you need to call someone like us. And we can help you figure that out.
Oh, I calculate make break numbers every week.
Yeah, because we know how to do it, and you may not like it when we do it. It may be a lot more than what you think it is. You may not have a solution for at the immediate time of when you're calculating make break numbers, because most of the time when we do it, what's the percentage that usually people are off? 10, 15%, somewhere around there?
Yeah, I'd say that's probably pretty fair.
So you think about that, like you guys are operating 10 or 15% lower than what you actually need to be. Like that is going to result in insolvency at some point in time. It may take a while, but at some point in time that will result in you not having enough to cover something.
Yep.
So you have to make sure you're ironclad on that make break number. And that's what having an advisor, especially one that knows your businesses like us, can actually do.
Yep.
And going through that. So what do you do, Gersh? You just go through a P&L and...
Yeah, I go through a P&L. I look at all their expenses and basically break out averages as far as operating expenses, debt costs, and basically how much do you need to produce to cover all these things.
And then just add in their profit percentages on top of that.
Yep.
To give them the right make break number. Okay?
Exactly.
It's not... no one just ever taught you guys how to do it. I mean, the accountants, CPAs, bookkeepers are not going to do it. They're just not.
No.
Right? Because they're reactive. They're looking for what actually happened. Whereas we're trying to be a cause point of what needs to occur.
Yeah.
So that's the gist on that. Okay. So, I mean, if you do all 7 of those things, my guess is that you are most likely going to be solvent, right? So I can say with a high degree of confidence right now, this may be the most important podcast that we've ever done.
Nice.
Right?
And who thought of the idea?
I did. I was like, I think we should do. I think we ought to do this. All right. So you actually came up. You actually had a bright idea. I'm actually surprised.
All right. Well, factor that into that raise we were talking about.
I will do that. Okay. All right, guys. See you on the next podcast.